How can you invest and make money in today's real estate market? Welcome to the Successful Investor Show, where we talk with successful real estate investors, business owners, and busy professionals on their journey to wealth. They share their best ways and advice to make massive gains in today's market. Make sure you are subscribed so you never miss an episode. Now, here is your host, Doron Nissim.
Welcome everyone to the Successful Investor Show, where we talk about how to passively invest and create passive income and generational wealth. I'm your host, Doron Nissim, and today I have the pleasure to welcome our guest, Paul Levine. Hi Paul, how are you?
Good, Doron, how are you?
Good having you here. Paul has been a commercial real estate and advisor for the past 20 years. He's been a tax consultant for actually 50 years. He's also been a professor in the University of Los Angeles teaching accounting. He's been helping a lot of people save on taxes and having strategies how to manage their real estate and taxes. So let's hear you, Paul, talk about your real estate.
Well, let me go back over my background. I was a practicing CPA for over 50 years. I was also a university professor at California State University, Los Angeles, during 6.5 years of that 50 years. And I have been in commercial real estate for about 7 years now. But the transition from accounting to real estate was very, very easy because the two mesh perfectly, because one of the reasons you buy commercial real estate is to save income taxes. And starting out with that premise, why does someone buy commercial real estate? You buy it for the cash flow, you buy it for the appreciation, and you buy it for the tax benefits, and you buy it to pass it on to your heirs. Let's talk about the cash flow. Cash flow can be used for current needs right now. People can live on that cash flow. They can retire on that cash flow. It can supplement any other cash flow that they have so that they can increase their lifestyle. Appreciation. Now, not every real estate investment is going to give you great cash flow. There are certain other real estate investments that balance out. For example, I don't know if our listeners realize what a triple net lease is, but basically you lease a McDonald's building to McDonald's. You know you're going to get your rent. And that is as safe as you're going to get. But the greater the risk, on that triple net lease is not going to be that great. Just so happens that self-storage units are a cash cow. People just bringing cash like crazy from self-storage facilities. So if that's what you're looking for, that's what you're going to buy. Yeah. Some people look for appreciation.
So let me ask you something. After you've been practicing accounting and being a CPA for 50 years, and then probably you saw your clients dealing with real estate, so you decided to transition into real estate. That what happened?
No, the funny thing is my wife came here from another country and she wanted to be a loan officer. And I took her down for the test and she couldn't drive, so I had 2 hours or so that I had to kill. So I figured I would take the test also, and I passed it. So since I passed the test, I came back and I said, maybe I should make this a career. And I was also very well versed in real estate because all the way back in 1972, before you were even considered. I had a client, a dear friend who called me up, and he was a family law attorney. And he said, do you know how to value a medical practice? Because he picked up the wife of a doctor as a client. And I said, I don't know now, but I'll know by noon tomorrow. And I took that afternoon and that evening and the next morning, and I knew how to value a medical practice. Well, I called him back and I said, we can do it. And he goes, Well, we've got a little bit of a complication. The doctor, who is very, very smart, 1972 had accumulated $14 million in rental properties with $7 million of mortgages for a net equity in 1972 of $7 million. So I went out and found the best appraisers in Los Angeles, and they ended up giving me a textbook about this thick. And I read that textbook back and forth, and I learned everything I was going to know about commercial real estate from reading that textbook.
Wow. So, I mean, in all of your dealings, all these years, what's the most successful deal that you ever saw somebody's doing or you did?
Now, I'm going to tell you an accounting story that has nothing to do with real estate, but you're going to love it. I negotiated the sale of one of my clients to this small company in Delaware called E I DuPont. You've heard of them?
Nope.
No, DuPont is one of the largest corporations in the world. And after I negotiated that sale, I got a phone call about 2 or 3 weeks later from head corporate counsel from DuPont telling me that my clients owed $250,000 extra in tax because the wife had done something that she shouldn't have done. And I said, let me call you back. And I called my client, and he was right, by the way. My client had to pick up what was known as phantom income. And I explained it to my client, and I said, can I play? And he said, yes. So I called the fellow back, and I said, I'm not picking up the income, knowing full well I'm not signing a tax return that's $250,000 shy in income tax. He didn't know that. He goes, but you have to. I said, I'm not. He goes, you have to. And I said, you know what it sounds like when a phone hangs up? I hung up on him. He called me back about 3 weeks later. He goes, you have to. I said, I'm not. He goes, you have to. I said, remember how we ended the last conversation? I hung up on him again. About 3 or 4 weeks later, my office, I live in Los Angeles, was in an area called Century City, and I lived in an area called Marina del Rey. And I stopped off at my favorite watering hole in those days and had dinner and drinks and showed up at home at midnight with a buzz on to a phone message from my client to call him in Wilmington, Delaware. It's 3 a.m. no matter what time it is. He picks up the phone. I said, I woke you. Pardon my language. He goes, no shit. And he goes, give me a minute. And he got back on the phone and he goes, they don't like you here. And I said, it's not a popularity contest. And he said, they made us an offer. I won't go through the numbers for you, but they wrote him a check for $570,000 that netted out to exactly $250,000, and they paid the tax.
Wow. That's amazing. They paid it all. They
paid it all.
That's awesome. And he made a bunch of money on this deal.
Probably, yeah, we originally sold the company for close to $9 million. So we had the money to pay the $250,000 in tax. I just didn't want him to.
Nice. That's amazing. And that's how you saved your clients money. And that's
I am a New Yorker. I was born and raised. I went to school on 23rd Street and Lexington Avenue, for those of you who know New York, and it was a 16-story building on the corner. Cost me $23 for my first semester.
Wow.
I said $23. Everybody that went to that school got a free ride. We had 2,500 day session students. Competition was fierce.
Wow.
So that's where I learned how to do stuff like that.
So, I mean, in all of your career, have you seen a deal that went sour or wasn't a good deal and people lost money? Can you tell us about that?
Well, I've seen a number of deals where it just didn't work out. I had a piece of land, a triangular piece of land in a city called Sherman Oaks, which is northwest of downtown Los Angeles in what is known as the San Fernando Valley. And my client contacted me. I represented them in the sale. And first I was talking to developer who was going to build condos on the property, and we were going to sell the condos. And then I started playing with numbers. It made more sense to build an apartment building because my client would have made more money if we built an apartment building. We're talking about 6 months, 7, 8 months maybe of time that we wasted only to find out that that piece of land was what was next to what's known as the LA River. It's the aqueduct where all of the water flows out to the ocean, and we couldn't build it there. So we spent about 8, 9 months playing with that. That didn't turn out to anything. On the other hand, a dentist came along and wanted the property to put his practice on. So we sold it for top dollar and everything worked out fine. But I got to tell you, I was not a happy person when I found out that we should have done that soil test a lot sooner.
Right. That comes from experience. I'm sure if you had next deal or something else that was similar, you would known to do the soil test and all that.
Yes. I went from being an accountant to being a real estate developer in about 20 minutes. And it took a lot of education, but I learned everything I had to, and I will just ask as many questions as I need to.
Right. I mean, usually you see that in the deal. If you don't have much experience, you end up after the deal having a lot of experience. Either you lost money, lost time, or have a lot of experience, or all together.
Mainly altogether.
Yeah, so I see that a lot. Yeah, it's a great story and it's a learning story. So what do you see in your business? What are the habits that you have that help you to be successful in what you do?
Back in the early 1970s, I took a class called active listening. And I really listened to my clients. I had a client come in. This lady was a dream client. She was delightful. She was very smart. She was the assistant vice president of the small hamburger company called McDonald's for marketing from the Rocky Mountains to the Pacific Ocean.
Wow.
Lady had a lot of smarts. And she came in and she said, oh, we have a city south of Los Angeles called Long Beach. Long Beach has canals in it, just like Venice, Italy. So your house banks up to the canal and you have a boat right there. And so she had a gorgeous house that she built. And she came in, and this is also in the 1970s. She goes, I'm going to redo my kitchen, and it's going to cost me $100,000. So 1970s, that was a lot of money. Yeah. And I said, really, tell me about it. And I had her talking, and I would go, yeah. I would parrot a couple of words that she said. And then at the end of an hour, and it was exactly an hour because there was a clock in the room, she goes, you're right. I'm not going to do it. And I didn't say a word. But all I did was let her get to her real feelings. And I've got a client in Austin, Texas right now who has properties in and outside of the United States. And the next thing I'm doing with my partner is we're going down to Austin, Texas to spend days talking with the husband and the wife, finding out what their needs, wants, desires, and goals are so that we can develop a real estate portfolio that are going to meet all of those goals. And that's what I do better than anybody else. No one, no other realtor has my tax background. No other realtor listens like I do. No other realtor has over 50 years experience like I do. And I listen and I get involved with my clients. If as a CPA, if by the time I did a second tax return for a client, we weren't friends, I fired them. I fired the client because I'm not going to work that hard for a client if I don't like them.
Wow. So in all your years in business. What's the mistake that you see most people do in real estate or in their finances?
Well, talking about real estate and in their finances, they become emotional. And in real estate, they become emotional. And if you make emotional decisions about money, you're making a huge mistake. And that's why I sit down and I will spend days with this lady and her husband in Austin, asking them question after question that no one else has ever asked them before. Because I want them to be very comfortable and very certain of what they want out of this. Do they want it for their children? Do they want it for their retirement? Do they want it for their ego? I mean, that's a legitimate reason.
Mm-hmm.
And if that's their reason, then, that's what I've got to satisfy. But I've got to find out what it is before I can get into that.
Right. Right. I mean, that's amazing. Most people don't have time now to talk and certainly not to ask questions. So, I mean, it's very nice that you do that to your clients and help them get to the points where they want to be. It's amazing. It's a great service that you give.
I'm not servicing my client if I don't do that.
Right.
Because I'm going to be doing what I want, what I think is right. What I think is right for them is not necessarily what they think is right for them.
Right. I usually ask about resource in your business, but you're a resource for taxes and real estate, and you have a blog that you talk about all the strategies. So can you tell us about your blog and your Facebook profile?
Well, not only Facebook, I do it on LinkedIn as well. Every workday morning. I used to do this 7 days a week. And then I got smart and realized that on Saturdays and Sundays, I'd like a life. So I stopped doing it on non-work days. And it was nice that we had Martin Luther King Day last week. Mm-hmm. But basically, 5 days a week, I will write articles on real estate, on saving income taxes when you buy and when you sell real estate. There is this, all right, the big thing about why people buy real estate is to save income taxes. And the way you save income taxes is something called depreciation. And I will give you the textbook definition of depreciation because I said it God knows how many times when I was a teacher. Depreciation is the systematic allocation of cost of a fixed or non-monetary asset, an apartment building, over the period of benefit. And there are many different types of depreciation that can be taken under the Internal Revenue Code. People right now are buying real estate, commercial real estate, in order to defer, not save, but defer income taxes. Because if you take all the depreciation now, you're not going to take any later. Mm-hmm. But present value of money says, I'd rather have $1 in my pocket today than have $1 in my pocket 5 years from now. So I'll get them that $1 in their pocket today, and they'll use it. And they won't have to come up with as much money for the deal because the income tax savings is going to help them finance the deal. And then something that very few people do, I also do, this is called a cost segregation study. I happen to be sitting in my dining area. This is where I work. And there are cabinets behind me. Those, when you buy an apartment building, you're buying the land, you're buying the structure, and you're buying, and these three words are very important, tangible personal property. The land is not depreciable because it's going to be there forever, except if you live in Southern California and the big earthquake hits. Then we have beachfront property where I live now. The building, the structure for a residential property gets depreciated over 27 and a half years, straight line. That means you take approximately 3% of the cost of that structure every year for 27 and a half years. But you have that tangible personal property that are the cabinets, the the ceiling fans, the doors, the pop-out windows, and I can go on for 15 more minutes, and those items get depreciated over a much shorter time. Well, years ago, the government came up with something called bonus depreciation. And up until 12/31/22, it changed on 1/1/23. But up until 12/31/22, you could take up to $1 million in bonus depreciation in 1 year if you were a real estate professional. If you weren't a real estate professional, your loss was limited to $25,000. It's
Wow.
still a nice loss. It's still going to save you income taxes,
Wow.
but it's limited to $25,000. Now, in the introduction, you used the word that's very, very important. You used the word passive income. Passive income to the layman means one thing. Passive income to the CPA and the Internal Revenue Service means something totally different. So when you say passive income, basically you're saying cash flow. And that's what you mean. And I think you should adjust that in the future, because that's really important, because that $25,000 is the passive loss limitation that you are allowed if you are not a real estate professional. So you have to be very
So,
careful.
so
Yeah.
you talked about the rule changed in the 1/1/23. So what's the rule these days?
Well, as of 12/31/22, you could take up to $1 million of depreciation of tangible personal property. Starting on 1/1/23, and for 1 year, you could take 80% of that.
Okay.
1/1/24, 60%, all the way down to 1/1/27, where it's zero.
I see.
But this hair isn't gray for no reason. The Internal Revenue Service and Congress, in its inimitable wisdom, changes the laws on us every week. And they're not going to take away that tremendous benefit in the real estate industry and stop building in this country. So there will be something. I don't know whether it's going to be called chicken soup or apple pie or what they're going to call it, but they're going to have something that's going to replace bonus depreciation, or else the building industry will cease.
I see. That's good to know. It's great to know. So I'm talking about passive income as being an investor or a partner, a limited partner in a syndication. So what can you tell us about being a limited partner in a syndication? What's the benefits of doing that?
I won't tell you the benefits. I'll tell you the huge detriment. And the huge detriment is you don't make the decisions.
Right.
I work as a CPA. I worked with entrepreneurs. It was me and the boss, me and the owner, me and the board of directors. And we made the decisions together. When you are a passive investor, using the word passive as you should, when you are a passive investor, you don't make any of those decisions. And your investment may be illiquid for a number of years where you can't get out. Whereas if you control the property, if you own the property outright, or with a really close group of friends who will do for each other, then if somebody needs money, you can always refinance the property and get the money out and not change anybody else's position. There are a lot of things that can be done. I could get really creative and make partnership agreements that you would absolutely laugh at, because I will solve everybody's problem that's in the partnership. And you can't do that in the syndication.
Right. Yeah, syndication is where a group of people come together, but you have a general partner that make all the decisions, and you have the limited partners that just invest the money.
And it's not really a group of people, it's individuals. Because when I said group before, I meant maybe 5 friends together.
Right.
All right. But we're just talking about people all over the country that put up 50,000 or 100,000 or whatever it was that they put up. And they don't know each other from a hole in the wall. and they don't care about each other.
Right.
And people's situations change over the years, and you've got to allow for that.
Right.
And if you're in an illiquid situation, somebody may be hurt. And that's not why you set these things up.
So let me ask you something. For people that have a full-time job, they have no time to look for properties or manage a property, what would you be your advice to give them to if they want to start to invest and they want to have some real estate in their portfolio?
Well, first thing to do is go out and buy one single family residence and rent it out. Then maybe buy a second. Or instead of buying a second single family residence, buy a duplex or a triplex for the second place. Now, I did exactly this with the client that I did his tax return yesterday. He bought a house. He had it rented out for part of last year. He's getting a great loss on his tax return. He's getting over $10,000 in refunds. And I told him that he must put that in the bank because we're using that as part of the down payment for the duplex or the triplex.
Awesome.
Now, also a duplex or a triplex has something that houses don't have. A duplex or a triplex, you build on all of the land. Whereas if you are buying single family residences, you've got backyards and side yards, and you're not making any money per square foot.
Right.
So you're paying the real estate taxes, the mortgage interest, and the utilities and the water and God knows what else you're paying in order to maintain that yard, whereas you're not getting any money from it. You're getting market value for the area. So I'd rather see somebody with maybe a fourplex or a fiveplex instead of 3 single family homes in 3 different locations.
Right.
And also you're centered in one place for the management.
Yeah, I love what you're saying. There are 2 points here. One of them that you said that you take the $10,000, you put it in the bank and use it for a down payment. That's called compound interest. You can leverage the earnings that you have and buy more properties and then move on to bigger and better properties.
And that's the objective. My
Right.
objective for this client. And like I said before, I used to fire clients if I didn't become friends. We are really, really close. And I have told him what my plan for him is after I listen to him and his wife for days and days and days.
Wow.
And our next
You have a lot of patience.
If you don't have hey, we're dealing with one of the most important things in a person's life: your life, your family, your money. Name something that comes above those 3 things: your health.
Right.
So I'm dealing with the essence of the person and their emotions and how they feel about themselves and a whole host of other things when you're dealing with somebody's money.
Yeah. Yeah, definitely. And the second thing is that you talked about multifamily is that you actually get to use the whole space, I would say the lot, to generate income and not just waste it on vacant land as a yard or things that doesn't produce income.
Right.
And I like that point.
And you can have a perfect piece of land with a house on it and rent it out for a lot of money. But I'd rather tear that house down and build a multifamily housing project.
Right. Right. And with the multifamily, you have less risk because if you have one unit that is vacant, you have other units that making the money.
Right. You don't have 100% vacancy factor.
Right. And that's the great benefit of owning a multifamily versus one single family house.
And that's another good reason for owning self-storage.
Right.
Because you can have God knows how many units of self-storage. And self-storage, I just mentioned before the cost segregation studies in tangible personal property, but that's a huge thing. People save tens of thousands or hundreds of thousands of dollars in income taxes, and you plan with that money. And you plan for the next largest purchase that you're going to make. And you got to have a balance. You have to have a balance of cash flow, of appreciation. You want some tax benefits now, you want some tax benefits later. Many CPAs don't know what a cost segregation study is. Many of them don't know what bonus depreciation is. I had somebody call me yesterday. We were on the phone for almost an hour, and I'm going up to Seattle to give a talk to 40 people to explain all of this stuff to them.
That's awesome. Yeah, not a lot of people knows about the bonus depreciation, especially not at cost segregation. So that's a great topic, and I'm sure we can have a whole discussion and a whole new episode just on that.
Have you got a week?
Definitely.
Well,
So,
I deal with this stuff every day. And this is what everybody asks. And especially when your accountant isn't doing it right, after 3 years, you can't go back and amend those returns.
right.
So you lose that money.
When people do their taxes or they make the tax plan, they should talk to somebody that's knowledgeable in the business, in the real estate specifically.
Yeah, specifically in real estate.
Right.
You got to go to a real estate CPA, and you should have a real estate attorney also, because it's a special industry. It's got special rules, and you got to know about it.
Right. Definitely. Yep, I love that. And thank you so much, Paul. This was great. I learned a lot, and there's so much more to learn. But
well, I got to tell you that I was really impressed because you asked some really good questions.
Thank you. Yes. But thank you so much. And our viewers will love this episode. Hopefully, we'll get to do another one soon.
Well, whenever you want. And let me just add one thing. Starting towards the end of this year, I'm going to be traveling around the United States to give talks about things like this in most major cities.
Wow. That's awesome. Sign me up. So if people want to get in touch with you and learn more and get the help from you, how can they reach out to you?
Okay, my name is Paul Levine, spelled L-E-V as in Victor, I-N-E. My telephone number is great. It's 818-298-4000.
Wow.
Pizza Hut had it before I did. And then they used to call me and order pizza, but that's another story. Anyway, but it's 818-298-4000. And my email address is plevinerealtor, REALTOR, @gmail.com.
That's awesome. Thank you so much, Paul. And we'll talk soon.
Thank you. This was a pleasure. I really
pleasure having you. Thank you so much.
Thank you so much for listening to this episode of the Successful Investor Show. If you're enjoying this podcast, please feel free to rate, subscribe, and leave a review wherever you listen to your podcasts. That helps others find the show, and we greatly appreciate it. Once again, thank you for tuning in, and we hope you'll join us on the next episode of the Successful Investor Show.